4 times a year, we get the opportunity to look at what the best investors in the world are doing. They're called super investors. They're called super investors because they manage a lot of money. So much money that the government requires them to reveal their portfolios, their buys and sells every single quarter. And that just happened for these super investors. Now, there's around 70 super investors, but out of those 70, I've gone through and handpicked what I believe are the best 15 super investors. So I've really narrowed this down to the best of the best, what I believe are the best investors in the world to learn from. This is going to be a very interesting episode. We're going to go through 9 super investors, and this is actually going to be broken up into 2 parts. For example, this episode today, this video, we're going to go over Warren Buffett, Bill Ackman, Terry Smith, Chuck Akre, Polen Capital Management, which is a great firm. You have Pat Dorsey, Christopher Bloomstran, Chris Hohn, and Michael Burry. 9 super investors today. So again, this is going to be a 2-part series. You're watching part 1 today. Let's go ahead and start off with Buffett. So let's go ahead and jump into Berkshire Hathaway's portfolio. This is all 41 positions of their public equity investments. Now keep in mind that Berkshire also owns a lot of companies outright that are not being publicly traded. So this doesn't include the dozens and dozens of companies like See's Candy that Berkshire owns 100% of. So this is really only a portion of Berkshire Hathaway, which shows you how big this company is. It's a massive company. Berkshire is now like a massive ETF more than an individual company. But we're going to look at his most recent trades in his equity portfolio. Of course, we had the breaking news. We know that Berkshire finally revealed what company they've been secretly buying, and it's Chubb Ltd., an insurance company. I'll go over this one in just a moment, but I first want to start off with Apple. We know that Apple was a core position for Berkshire. He called it a pillar of the company, and it raced up to roughly 50% of their equity portfolio. That was a lot, even for Buffett. He doesn't like having that much into one company. I know he says that diversification is for protecting for ignorance, but even in the case of Buffett, I think he's reluctant to have over 50% of the portfolio in one single company, even if it's as good as Apple. So he did something that I kind of expected him to do. He trimmed Apple. He trimmed it by 13%. And this was around 6% of the overall public portfolio. He was asked about this. Why did he trim it? And he didn't really give a straightforward answer. He basically said that part of it was to pay for taxes, and that he reiterated he's still very bullish on Apple. But I want to try to fill in the blanks. I want to try to go past what he said here. Buffett's one to never try to talk down a stock. He doesn't really want to crush the stock price of a company that he owns, especially a very large position. So whether it's See's Candy, Coca-Cola, any company that he's invested in, he always talks positively about them, even if I believe internally he's feeling a little bit more cautious or a little bit more guarded about the current value proposition. In the case of Apple, he didn't really say anything negative about the company. He still says it's a great company, one of the best in the world, but I think there's more challenges in Buffett's mind. First of all, Apple is growing slower, a lot slower than when he first bought the company. Apple's at a much higher valuation than when he first bought the company. Apple faces more regulatory risk than when he first bought the company. So you have Apple, his largest position, that is now more expensive, it's at a greater valuation, it's growing slower, and it has greater regulatory risk. That's not the same equation as when he bought it. As a reminder of when he bought Apple, the entire position was purchased between 2016 and 2017. So he bought all of the company at these prices down here. If we look at the specific price, that was around $28 to $42 per share. This is when he was buying Apple, $40 a share, $35 a share. It was dirt cheap. It traded for a 16 PE ratio. He built a massive $30 billion stake in the company right there, and then he just held it. During this time period, he held around 1 billion shares of the company, so he had a massive stake in the company. And ever since then, since those very first purchases at $30 or $40 per share, he's basically sold the company. He trimmed it a little bit in Q1 of 2020, and then he held it a little bit more. He bought a tiny fragment of it in Q3 of 2022, and then recently he dumped 13%. And I do believe him when he says that he's still bullish on the fundamentals of Apple. But the simple truth is the equation has changed over time. So I agree with this trim in Apple, and I've done the same thing. Now, if we move on, we have some other small trades here. Nothing that I think is notable, just slight trims and slight additions to some different oil companies. The biggest news that came out of this filing was that he bought a new company, which is Chubb Ltd, ticker symbol CB. And he's made this into a 2% position. Now, 2% sounds small, and it is in the grand scheme of things, but in Buffett's portfolio, that's actually a pretty decent buy. This is company like number 10 in the portfolio out of 41 positions. So this bumped right up to the top percentile of his portfolio. Let's go ahead and take a look at what Chubb Ltd is. We can bring up CB here on Qualtrim. And if you don't know, this website is something I've built. It's included as part of the Patreon. We bring up Chubb Limited here. It's up 4% on the day. Qualtrim's telling us this is because of Berkshire Hathaway buying it, which is the truth. He buys a company. When it gets released, the stock price will go up a little bit. You can read the long-term description here of Chubb, but just to summarize it, it's an insurance company. It's an insurance company that's similar to other insurance companies. And you know Warren Buffett's history with insurance. Geico, a major position of his that he's made a fortune with, that's been one of his best positions ever. Of course, he loves insurance companies. So it makes sense that he wants to buy more insurance companies. Now, if we look at the valuation of this company, insurance companies have to be valued differently than normal companies. You do not use free cash flow. So just get rid of that when you're doing insurance company valuations. You look at the PE ratio, which is at 11. So it's very cheap, an inexpensive company, which attracts Buffett to it. And you also have the price to book. It's 1.6, which is also not the cheapest for an insurance company, but not expensive. Overall, Buffett's buying a cheap insurance company. And I believe the reason why is to get more access to cheap float. Buffett knows the power of float. Float is the amount of money that you have left over from insurance companies due to payouts, but you don't have to use it. You only have to use that money if you need a payout. In the meantime, you can invest that float. And float becomes more valuable when interest rates go up. So it makes perfect sense to me that Buffett would want to buy into a cheap insurance company as interest rates have gone up, as the float becomes more attractive. I think he looks at this as cheap access to investing capital. The only other notable thing that Buffett has done recently is sold off his Paramount Global stake, which I think was a good move. I've always thought that Paramount Global has been a value trap for years, so I'm glad to see that one go. So overall, all the trades Buffett has made, trimming Apple a little bit, buying an insurance company, and dumping Paramount Global, I agree with them. I think they're good moves. Now, next up, we have Bill Ackman. He's a super investor because he manages over $10 billion. He's had an annualized return of around 16 to 17%, and he invests in what he calls dominant free cash flow companies. He's made a lot of money on different food joints, companies like Chipotle, companies like Burger King, companies like Starbucks throughout his past. So he likes investing in these different food joints. Now, if we look at Bill Ackman's most recent trades, I first want to start off by looking at what he's recently sold. He's sold out of Lowe's completely. I think that's a good move. I've said before that I don't want to own anything that has anything to do with houses or big loans. Things you have to go to the bank and get a big loan to purchase. In many cases, home renovations and redoing your backyard and doing construction projects, those are things that require a lot of capital. And now that interest rates are a lot higher, I believe it's going to be more of a struggle for Lowe's. So this is one that I think was smart to move out of, and I've done the same thing. I've been out of any company that requires large loans for a long period of time. If we look at his current portfolio right now, he did make some trades last quarter. The only trade he made was that he sold out of Lowe's, and he also trimmed his Chipotle position by roughly 10%. I've invested in Chipotle for a bit over a year, and the stock is just nuts. If you look at what Chipotle's doing, it's really incredible. I bought Chipotle just a year ago around this point. I thought it was in a dip and it had a decent value proposition. And then they had incredible same-store sales growth over and over again, while simultaneously, almost every other restaurant is not doing well. Chipotle and Texas Roadhouse are two of the only restaurant companies doing well. Ones like McDonald's, Starbucks are having major pullbacks. So this company has really outperformed its peers to a huge degree. So I look at Bill Ackman, and he's probably thinking, You know, I've owned this company for years. He's made almost 5 times his money on Chipotle. It's gone up to all-time high valuations. It has so much bullish sentiment and momentum in the stock that it's almost a guarantee things aren't going to go this well forever. Things never go this well forever. There's going to be some bad quarter, some bad sentiment, something negative that happens that causes the stock to trade down a little bit off of its 55 forward PE. So when I look at Chipotle, I acknowledge it's a one-of-a-kind company. It's a world-class asset. I think it has incredible growth opportunity, but things are just going so well that it's hard not to want to take some gains right now. When I look closer at Bill Ackman's portfolio, I agree that it has many of those dominant, great companies that he talks about, the free cash flow generative companies. But there's one position in his portfolio that I don't like. I like Chipotle. I like Hilton. I like Google. I like Howard Hughes Corporation. I love Canadian Pacific. I don't like Restaurant Brands International. And he has this as a massive 17% position. This is one that I just don't understand the investment thesis here. In the past year, it's down 3%. In the past 5 years, it's up 5%. So the stock has been flat the entire time he's owned it, which I think is okay. It's okay to buy stocks that go flat for a while. But even when I look at the investment case here, Restaurant Brands International owns Burger King, which I believe is one of the weakest brands of burger joints. I'd rather own McDonald's than Burger King. There's not a lot of metrics moving in the right direction. And this is also a company that has a lot of leverage in the business model. So this is one that I don't agree with. I don't like QSR. I think there's much better investment opportunities, even in the food category. So I wish he'd switch this one out. But overall, all the other positions I really like. So I think this is overall a very strong portfolio. Now, next up, we have Terry Smith, the investor known for buying high quality companies, not overpaying and holding on to them long term. That's his overall investing thesis. But he's very analytical about how he does it. He looks at things like the return on capital employed. And so far, he's managed to have around 15% returns for a long period of time. So he has beat the market for a while. But more recently, he's made some major missteps with his fund, in particular on his selling. His selling has gotten him in trouble over and over again. And one of the notable things that has changed for Terry Smith is that he's a massive fund manager. And Morningstar has always rated him as a gold fund. Gold because of how stellar and how consistent his performance has been. But with the major missteps he's made over the past couple of years, they've downgraded that to a silver. I want to go over the reasons for this downgrade. So here we have a video from Morningstar where their analysts are describing some of the major missteps he's recently made.
I'd like to draw attention to Terry Smith's sell discipline, which in recent years, and particularly the last 18 months, has really come to the fore. We tend to see this kind of thing happen for buy and hold managers when they see some outflows. But here, what I see as a slight lack in rigour is really something which I've taken a look at. So PayPal, Terry Smith says he sold that too late, and there are a number of management missteps there.
He held on to PayPal all the way down. So he lost a bunch of money in PayPal. Terry Smith sold it way too late. And then he kind of blamed the management of PayPal as kind of like a reason to excuse his selling it too late.
Estee Lauder, which had some difficulties in China, was similarly painful for the fund.
That's another one. I sold out of Estee Lauder at a big profit because I listened to one earnings call, and it gave me so many red flags that I thought I have to exit out of this position today. Estee Lauder's management went over uncertainty after uncertainty with that earnings call. And so I decided to sell the position because it was trading at a higher valuation. Terry Smith hung on to the position all the way down. Estee Lauder was another one, like PayPal, that just plummeted.
These were sold too late. On the other hand, there are also a couple of positions that were sold too early, or at least according to Terry. These were fundamentally justified, but then the price took off afterwards, in part due to the massive tailwinds from AI. So that was Amazon and then also Adobe.
He had positions in Amazon and Adobe, and he held on to these companies when they're doing okay. And then we know in 2021, they both took a huge dip. Amazon went down like 50%. Adobe went down even more. These were companies that I was pounding the table to buy during those lows, specifically Amazon. I added a lot more to Amazon at like $80 or $90 a share. And at the same time period, Shockingly to me, Terry Smith decided to sell his Amazon position almost at the complete low, the worst time possible. Now, he held on to his Meta position, but selling Amazon at the low was such a bad move for him. So you have a couple instances where he's selling too late, and then you have these instances where he's selling way too early. Another example of a poorly timed sell from Terry Smith recently was Intuit. He had Intuit as one of his big positions. He was invested in the company, but then he sold out after writing a scathing letter to the management team of Intuit, saying that they're doing deceiving accounting metrics. Right after writing that letter and selling out, Intuit stock proceeded to surge around 70%. So that was another just misfortunate time by Terry Smith. So he's gone through a string of situations of selling either too early or too late, and overall that's damaged the performance of Fundsmith over the past year. It's underperformed the market because of these poorly timed trades. Now, if we look at his portfolio today, I look at it and I notice a couple trades here. He's trimming around things like trimming a little bit of Pepsi, trimming some McCormick. He's buying into Texas Instruments. That's a new position he bought into. He bought a little bit more Apple on the dip. So he's doing the opposite of Buffett there, buying Apple when it dips down a bit. That's interesting to see. He trimmed a little bit of MSCI. This is one that I don't know why he's trimming right now. I think this would be a good one to add to right now. So overall, I have a mixed view on his trades. I think he's doing a good job of just buying a group of high quality companies and holding on to them. But when I observe the individual trades he's done recently, I haven't been impressed. He needs to go back to his roots of buying high quality companies on a dip and selling them after the fundamentals start to give red flags. If he'd followed that simple formula that he outlines, he would have had a better return over the past 2 years. Now, next up, we have the super investor Chuck Akre. There is one caveat here, though. Chuck Akre himself is a legend. The guy is one of the best compounding investors over time. He invested in a lot of companies like MasterCard and Moody's at bottom valuations and held on to them year after year after year with diamond hands. That was what he did. He bought great companies and he held on to them with diamond hands. But the caveat here is that Chuck Akre himself is still on the names of many of these funds, but he himself has stepped down from managing these funds. He's passed the baton on to different portfolio managers. And there's never really the same. You can't replace a guy like Chuck Akre. In many cases, even though someone has watched him invest and they think they can mimic what he does, they're not going to mimic it as well as he does it. So what we see here is a little bit of a deviation from his previous strategy. Let's go ahead and take a look. When we look at his portfolio, he still has MasterCard as a top position and then Moody's as the second largest position. But you'll notice that almost every quarter, they're trimming and trimming more of these wonderful companies. That just doesn't make sense to me. I look at their value over time, or their amount of shares held over time, and this is when he's been stepping down. After that, the new portfolio managers are selling shares of MasterCard. What is wrong with MasterCard right now? Why are they selling shares? When I look up MasterCard and I review the fundamentals and the valuation of the company, everything looks really good. It's at a 30 PE ratio, which it's traded at for a long period of time. It's at a 2.5% free cash flow yield. The company has incredibly consistent growing revenue over time. The company has revenue growing in both segments, their value add service and their payment networks. The company has more and more people every quarter using MasterCards, both their debit and their credit cards. You can look at the total amount of MasterCards over time on Qualtrim. Last quarter, it was 3.01 billion MasterCards worldwide. Many of these are international. People are going to spend more and more on MasterCards every year. So I look at the fundamentals of the company and I can't find any weaknesses. I look at the free cash flow and take a look at this chart. It just looks incredible. I look at the EBITDA of the company and the earnings per share, the share count going down, the dividend growing. So when I go over the possible reasons for trimming MasterCard, I don't believe it's based on weaknesses in the fundamentals. I believe it's based on valuation. And I believe that if Chuck Akre himself was still running this fund, you would see the share count remain steady. You would not see the share count going down. I believe that it's the new managers trimming MasterCard because of a perceived valuation problem. We have the same thing with Moody's. They sold another 6% of their Moody's position at the very same time. We have Uber here. This is a new position in the portfolio, so no history with it. But I find it odd for them to sell out of MasterCard and Moody's and buy Uber. Another company that they're buying into new is called CCC Intelligent Solution. This is a software company that, by their own description, they provide cloud, mobile, and AI telematic hyperscale technologies and applications for the property and casualty insurance economy. Very complex sounding company. When I look over the fundamentals, they look okay. Not great. They don't have consistent earnings per share growth. They have positive cash flow and growing revenue, but this isn't the type of company that I typically see Chuck Akre buying into. He usually buys already great firms that he can extrapolate great returns in the future. So overall, when I look at Chuck Akre, I still think it's a great portfolio, and it's still following overall the blueprint of very high quality companies, compounders, but I think his recent trades, especially under the new management, are a little bit questionable. Now, next up, we have a firm called Polen Capital that manages $43 billion, and they run a focused growth portfolio where they've had around 15% annualized returns. Many of the companies that they hold, if we take a look at their portfolio, it's very similar to the type of ones that I hold. A lot of them are more tech focused, they're growth focused. I consider these companies to be overall very high quality. Now, we can take a look at the trades they've done this last quarter. They've invested in Amazon and Microsoft a lot last year, and they're trimming down these positions slightly. They trimmed 5% off their position on Amazon, but it's still overwhelmingly their largest position, 15%. So if you talk to the managers at Polen Capital, they'll say that they're incredibly bullish on this company. They really believe in this story of Amazon generating record profits, and that's why they've positioned it as roughly triple the normal size position of a company in their portfolio. So huge bet on Amazon still, but as Amazon goes up, they're taking a little off the table. Then they hold Microsoft, Google, and Visa. All of those they've been trimming a little bit, except for Visa. Visa they've actually added to. They added 15% to Visa, and they took a little off the top from MasterCard. I think they do this because they see a little bit of a valuation discrepancy. And overall, this is something that I've noticed with Polen Capital. They don't do the buy and hold strategy. They're constantly rearranging positions and trading positions. Like if you look over here in the activity, every single position they're trading down or up by 10, 20%, and that's a lot of trading. They've said before in an interview that all of this trading really hasn't yielded superior returns. They've had kind of neutral returns from all of their little trading. If they would have just held on to the positions they originally bought into, they likely would have had even better performance, especially when you factor in transactional costs. So I don't really like the strategy of trading 4 or 5% of a position every single quarter like they do. But regardless, this is one that I like to follow because I like the company selection. For example, they just invested a bunch more into Thermo Fisher Scientific, another one that's very high quality, great returns on capital. They also bought more Abbott Laboratories and Airbnb. A lot of these companies are super high quality companies. Overall, I think it's great. Now, next up, we have Pat Dorsey, the one that developed the Morningstar Moat Rating System. Let's go ahead and take a look at what he's been up to. We have his portfolio here that looks relatively the same, not a lot of differences. We still have Meta as a very top position. He has reduced his Meta stake by 25%. Makes sense. It's traded up a lot. He's taking some off the table. And then the other positions he's left roughly the same, reducing all of them by 1%. He's reduced Herc Holdings by 13%. And then there's a couple additions to the portfolio. The first major addition is a new position, which is AutoZone. He added AutoZone to the portfolio as an 8.5% position. Let's go ahead and take a look at AutoZone. This company is called a cannibal. It's a company that does buybacks galore. It's a buyback machine. Take a look at their shares outstanding over time. In the early 2000s, they had around 140 million shares, and now currently they have 17 million. So this is how this company operates. Just last year, they bought back 6% of their shares outstanding. When they remove the shares outstanding, it grows the earnings per share and the free cash flow per share. When you grow earnings per share and free cash flow per share, the stock price goes up. So as they've been doing these incredible, consistent buybacks for decades, the stock price has also been a massive winner, going up 450% over the past decade. Now, the only thing that confuses me about this recent buy into AutoZone is that's been the same investment case for a long period of time. And I can't find anything that's changed recently. There's no dip in AutoZone. The company's gone up this year so far. So I don't see any specific catalyst of why he would now add this company to his portfolio. But either way, I don't think it's going to hurt things. Overall, I like the portfolio of Pat Dorsey today more than I have historically. A couple years ago, I wasn't impressed, but I like where it stands right now. Now, next up, we have Christopher Bloomstran. He manages around $400 million, and he has more of a fundamental analysis style where he invests in cheaper companies. He's a big follower of Buffett, and a lot of his portfolio is in Berkshire Hathaway. So around 30% of Christopher Bloomstran's portfolio is invested directly in Berkshire. I don't really agree with doing that just because I think if you're going to hand your money over to Christopher Bloomstran and then he puts your money with Berkshire, you could just invest directly in Berkshire. But either way, he likes trying to invest in Berkshire at a discount to its intrinsic value. So he'll buy more of the company when he thinks it's underneath its fair value. The other notable additions to his portfolio, or the things that he's been doing recently, is instead of selling out of Paramount, he bought in big. He increased his position size by 65%. This has been a losing position for Christopher so far, but he still thinks there's hope. He believes he's getting dollars for pennies here. I think the story of Paramount is one that's in distress. They're eventually going to have to sell it off. That's going to be very complex. They're going to have to craft a deal to do it correctly. The position that he reduced is Disney. So he reduced his Disney position by 34%, and he increased his Paramount position by 65%. See, if I was doing this, I would be doing the complete opposite. I'd rather be buying into Disney right now and selling out of Paramount. So you see some differences there. He's focusing, I believe, the most on valuation, which right now Paramount is very, very cheap. He's also adding to Starbucks. He increased the position size by 20%, and I think he probably will increase it more after this most recent sell-off. I think that this is a decent move. Things are really bad for Starbucks right now. We can look at the stock and you can see it getting punished right now, and their same-store sales are declining, their app usage is declining, there's a lot of concerns about competitors and so on and so forth. But that's typically the best time to be entering into a position and be increasing positions, is as these great companies like Starbucks go through troubles. The troubling time for Starbucks won't last forever. So although I'm not buying the stock right now, I do actually like seeing this buy, buying into weakness. Other than these trades, I don't see anything too notable here, some shifting around in the portfolio, but it largely looks the same. Overall, I think that Christopher Bloomstran's portfolio is safe, conservative, but I don't think it's going to have incredible performance over the market. Now, next we have a very good super investor, Chris Hohn. I think he's one of the best, and he's recently had a string of some of the best performance of any hedge fund manager. In fact, over the past couple of years, he has been the top hedge fund manager. Let's go ahead and take a look at his portfolio. He manages $40 billion, so he's attracting a lot of funds because of his recent success. And we look at some of the things that he's had as huge winners. One of them is GE. He really nailed GE. This was one that he got so correct. He invested in this company. Let's take a look here. He invested most of it in Q1 of 2023. So that's when he bought in, and then he bought a little bit more in Q2 of 2023. And of course, when we look at the stock's performance over that time period, he was buying it right around here, right before it took off, and it went through a string of performance where the stock price nearly doubled. The biggest change he's made this quarter is he's reduced his position a little bit in Thermo Fisher Scientific, and he added more to GE. Other than that, most of his positions look relatively the same. I continue to believe that Chris Hohn will beat the market by a sizable amount. The companies that he's concentrated into are monopolies. They're incredibly difficult to disrupt, and he has diversification across different factors. He's not investing in all of the same types of companies. These are ones that operate in all different types of businesses. But overall, it's an incredibly strong portfolio. I think stronger than the broader market. Now finally we get to Michael Burry, who needs no introduction. Burry made a series of trades like he always does. Here's his activity for the past quarter, and he's buying and selling a lot of stuff. But if I were to summarize it, the major moves he did this quarter was he sold software. So US software companies like Google, Oracle, all these type of companies, he sold out of them. Amazon, he dumped that as well. MGM, he dumped that. Warner Brothers Discovery, he dumped that. All these different stocks, they're gone. And then he bought into Chinese retailers. He increased his position size dramatically or bought into new ones. Again, the other software companies, Toast, a restaurant software company, he dumped out of that. So a lot of different software companies he got rid of, but he bought into Chinese retailers and commodities. Companies like Gold Trust, Cigna Group, and BP. These are other big additions in his portfolio. So overall, the portfolio looks like this. He has JD as the largest position, Alibaba, we have Citigroup, we have Block. That's one software company that he kept. But it's hard to make sense of this. It's a lot of different companies. And this is why I think it's so difficult to try to mimic what Michael Burry's doing. The one major thing I see Michael Burry continually do is he buys into the most hated places in the markets. For example, right now, Chinese retail companies are probably the most hated portion of the entire global market, and those are his top positions. So he likes buying where nobody else will buy. He doesn't care about the sentiment. He doesn't care what other people see. He just looks at the value himself, and he'll buy into those situations. Now, I'm not going to be mimicking his strategy, but I do think it's cool to see him go where other investors aren't willing to. Now, that concludes part 1. We went through 9 super investors and looked at what they're doing. But we still have part 2 where we have another 8 super investors to go through, including ones that are really great, like Devkant Desaria and Brad Gerstner of Altimeter. So we have a lot to look forward to. I hope you enjoyed, and I'll see you in the next one.